Hi guys, if you are someone who has high amount of debts on your credit card, on your car loan or some other, thinking moving ahead with your new real estate purchase, this video is for you.
Hi guys, if you are someone that's looking to maybe do a move-up purchase, but you're just not too sure about losing that 3% interest rate that you had locked in a couple years ago, well, we'll show you how we can make it make sense and how we can make it easy as can be.
This is Emmanuel Blackmore, a mortgage advisor and banker and all the money guy. I am MYKHAILO BURTOVYI real estate agent here in Miami, Florida. So let's get started. What's initiated, what started, what triggered you to start recording this conversation and help people?
This is a huge conversation that I've been experiencing over the last few years because we've been in a very high interest rate environment, and there's a lot of people that are sitting in their homes and they feel trapped, right? Because they've locked in this 2%. Very rarely, most people are actually in between the 3 and 4% if we're gonna be statistical about it. And even then they're still feeling like, I can't let this interest rate go, right? Because, well, if I let it go, then I'm at a 7% interest rate, I'm at a 6% interest rate, and that doesn't make sense, it's too expensive for me, so on and so forth. So this has been a way where we can show them, don't feel trapped, there's always an option, and we have done this in multiple cases where we actually save them money on their monthly payments rather than increase on their monthly payments, and they got a bigger house out of it, so it all works out.
So guys, if you are someone who is looking to get a bigger house, this video is for you. Please keep watching this video until the end. Okay, many tell me how they can start this process, what will be the step number 1, 2 and 3 in order to get out of this situation and get out of this trap of this thinking about this 3% forever.
I guess it's really dependent, right, on the scenario. First, it's definitely going to be one of those things that only fits people that need to move up. You know, you have people that have more kids, you need a new room, you need to get a new car, you need a garage now. You just got a new dog, you need a backyard now. That's what the move-up purchase is for. It's not just for someone that, hey, I want to buy another house, right? So we do use this on a specific demographic of clientele, okay? The other thing that we need to make sure is they have some sort of debt, right? This isn't gonna work for someone that, you know, never uses credit cards, never gets a loan. You know, while that's great, that's not everybody. I mean, we spoke about it before, right? The amount of people with credit card debt is astronomical right now. We passed above $1 trillion in credit card debt in the United States. Never before seen, right? Even pre-pandemic. So it's very tough. And on top of that, we have people with credit cards that were originally at 14% maybe in the beginning of 2022 that are now getting repriced at the end of 2023 into 2024 at 24% interest rate, 25% interest rate, right? So the amount of interest is going up on top of the amount of debt that they hold is going up. So a lot of people that are drowning in it, and it's actually most Americans, the average American. So those are the things that I look for before, you know, moving forward with this conversation, okay? And that is how we qualify, okay? And then the second part of the question is, what's the instrument? Loans, man. Loans, money, man. That's the way we do it. So the way we first would show you how we would save you money is we would make sure we get a good credit report, right? I want to see your credit report, I want to see all your debts, right? I want to see your credit card debt, I want to see your student loan debt, I want to see your personal loan debt, I want to see all of that, right? And then I'm going to need to find out what's the interest rate for this person, what's the interest rate for this credit card loan, and then I have a system that will analyze that, and we call it our blended rate calculator. And what that will do is I will show you exactly how much you are going to be paying in interest on all of your monthly debt, rather than, you know, picking and choosing. Hey, I have a 3% mortgage. but I also have a 25% credit card. I also have a 12% HELOC, that type of stuff. So this will blend it. And once we start blending these debts, we actually see that most people are paying around 7%, 8% in interest on average for their debt, on average across the board when we average out those debts. So, you know, I understand that maybe one debt you don't want to be too high because the other debts are higher. But what if we were to wipe away all those other personal loans, student loans, credit cards, all those loans, and now we only have the mortgage, and the mortgage is at 6%. Your blended rate calculator showed that you were at 8% interest on your debts, right? Of course, we balance it out. Of course, it's going to be weighted based off the amount of debt that you have outstanding with each creditor, but it doesn't mean, like I said, that you're just because this is a lower debt amount that you're gonna, you know, have a lower overall interest rate. So that's the first thing that you do, right? We sit down, we advise on this is what you're looking at monthly. If we were to refinance you, this is what the credit card or the mortgage would be monthly. Okay.
So basically, you have big proper instrument that allow to see big picture. All debts, on all interest rate, on all amount they pay monthly, and it will average up, and to see where you at right now, somebody at right now, and they are going to see if we will use your refinancing. Tell me please, Manuel, what will happen if the situation will continue going this way it's going right now? What will happen with that person?
If they keep the credit cards, if they keep...
Correct. If they will not call you and call us, and they will stay where they are.
More than likely, what they're going to end up having is a problem with debt. They're going to need to do a debt consolidation loan from another lender. They're going to get a personal loan with higher interest debt than a mortgage would have, and then it's going to be a position of, you know, you're still paying on a higher interest actual debt consolidation loan rather than on a lower interest collateralized loan like a mortgage. We know that there's a lot of people that need more mortgages on bigger homes that are sitting in smaller homes that don't fit their family anymore, right? There's about 3-4 years that you typically stay with a mortgage, about 7 years that you stay with your first home.
Okay.
Right? When we think about it, how much happens within those 7 years of life? A lot can happen. You could graduate college, start 3 jobs within that 7 years, right? So your whole characteristic, whole outlook on life is going to change, right? So you don't ever want to sit in a spot where you're not comfortable just because you're afraid of losing an interest rate, right?
Right.
So this is a tool for it to make sense, okay? Now, when we do these debt consolidation loans, right, and we run these blended rate calculations, you want to make sure that you have enough equity in that home that you're selling, right, to put down payment on the new move-up purchase, as well as to put as payoff of the other debts, okay? Now, when we have enough equity there to put as down payment and pay off debts, this is a great option for you. If you do have high interest debt and you don't even want to do a move-up purchase and you just have a ton of it, but you've been living in your house 5, 6, 7 years, typically you're gonna have the equity to pay that away, and we can refinance. Debt consolidate means pay off that debt, and then you can still live in that property with a similar mortgage. Of course, it's gonna have a higher interest rate, but you're not gonna have all those other high interest debts. So your monthly out of pocket is most likely gonna be less than if you were to just go forward with paying out all these other creditors and paying a lower mortgage rate. So speak with an advisor. You are more likely gonna have a specific case scenario, and that specific case scenario needs to have a tailored solution for you rather than this fitting everybody that wants to do a move-up purchase. So, you know, speak with me, speak with your real estate professional, and they will have a referral for you, hopefully with a great advisor like myself or a banker that can, you know, speak on these things and make sure that this is something that is advantageous for you.
Your advice will help many people to find the way from their difficult situation in their life, and we are here, guys, to help you.